Hello, this is Amy, and welcome to my channel, Amy's Hidden Ledger. Today, I would like to talk about what should we do with our money if we were hit by a recession. Now, every time the market gets shaky, people start advising you, stop buying whole cash, wait for the drop, then jump back right in when it's lower. On surface, that sounds very smart. Nobody wants to buy today and watch their account for another 10 or 15 or even more percentage tomorrow. However, for people who are still building wealth, especially the high earners with a long runway, that instinct may be exactly how they fall behind. So in this video, I want to test a very common belief. When the market looks dangerous, is it actually a smart move to really pause investing, wait for clarity? Or is it that those ideas that feel responsible but quietly costing you more money? Now, to be fair, smart people believe this for a reason. So if you are a parent, you have a mortgage, you have daycare, you have a demanding job, and not a lot of mental bandwidth, the ideas of waiting for more clarity feels more reasonable. It feels more responsible and it feels more disciplined. Losses feels immediate. Headlines feels urgent, but cash feels very safe. And if you do not have time to stare at charts all day, the temptation is even stronger. You tell yourself, I'm not panicking. I am just being prudent. That's why this myth is so sticky. It does not sound reckless, it sounds mature. The problem is that logic quietly makes up two very different kinds of investors. The first mistake is treating retirees and accumulators as if they are the same. But they're not, they don't have the same problem. If you're retired and taking withdrawals, a market drop is mainly a threat. But if you are still buying assets every month and retirement is more than 10 years away, a drop is not only a threat, it is also lower prices on future shares. That is a completely different setup. A crash hurts sellers more than buyers. So when somebody says, just wait until things settle down, that advice might make more sense for someone protecting withdrawals, someone who's a retiree, than for someone who's still in the building phase, i.e. someone who's 10 years away from retirement. And then there's the second mistake, which matters even more for high earners. Timing is not free. If you are a W-2 high earner and you sell appreciated assets in a taxable account just to wait out a correction, you're not stepping into cash for free. You may be triggering capital gains tax. And for many high earners, possibly the net investment income tax too. So now your timing decision has a much higher bar. You do not just need to be right about danger, you need to be right enough to beat the market decline, beat the tax bill, and then still get back in on time. That is a very different challenge from the simple headline version of sell now and buy lower later. So let's test the fantasy version of that strategy with the timing advantage turned up as high as possible. Now let's move to the quant test. Let's see if market timer gets a better result. Now, in this quant test, we give market timer an absolute advantage. They know the exact bottom in advance, not roughly, exactly. They also get to sit in cash earning 3% while the market is falling. In other words, this is not a normal human investor. This is basically giving them God mode. And even then, the edge over boring monthly buying is much smaller than most people would expect. For example, in the 2008 crisis window, the boring DCA, if you buy $1,000 every month, that turns $120,000 contribution into about $233,000. The perfect timing God mode give you $259,000. So yes, timing won, but the gap was only about $25,000 over a full decade. That is absolutely minimal, and obviously no one can time the market that perfectly. And in the 2022 bear market, the edge was only about $2,300. And it's like even smaller. So this is the part that people really misses. Even perfect timing often does not produce the massive payoff that people are imagining. And here is the ugly detail. The timers only wins if they are basically perfect. Once a real human misses the bottom by a few months, that already very thin advantage can disappear very fast. So the real game is not, can I predict danger? The real game is, can I predict the bottom, add on it, and then re-enter it on time? And that's where most people fail. The sell feels smart. However, the re-entering is where portfolios quickly breaks. Because when the rebound starts, it rarely feels safe. Headlines are still negative, the economics still looks really messy, and the investors who felt clever getting out now had to make an emotionally even harder decisions to get back in. And that's why waiting for clarity sounds very good in theory, but often fails in practice. Now, layering taxes back into the picture, which makes it even worse for high earners. If you're investing through retirement account, the main risk is just pausing future buyings when prices are lower. If you're using a taxable brokerage account, you're creating a real tax bill now just to avoid and imagine the future loss tomorrow. So for high earners, the IRS could get paid 20 to 30% right now, depending on your tax bracket. However, we just demonstrated, even in God mode in 10 years, you're probably earning 10% more, and that's it. So the problem is not, is a correction coming? Correction happens. The real question is, what kind of money is this? If this is long-term retirement money and you're still accumulating, the boring plan is often the most intelligent plan. If you do need the money in 3 to 7 years, or you are a retiree right now, then that is a different story. That is the framework that really shifts that matter. So here is the practical takeaway. Step 1, separate your money by job. Retirement money, medium-term money, emergency cash, this should all be in separate. Step 2, automate the retirement bucket so headlines do not get a vote at all. Step 3, if fear is rising, change your screen habits before you even change anything on your portfolio. Delete the trading app from your home screen before you even touch your allocation. And then just do one very simple check. Pause for 10 seconds, look at where you automate your 401 contribution or brokerage transfer, make sure they're still on, and that's it. So not your opinion, not your forecast, just that one setting. The automation is still on. Because for most accumulators, the biggest wealth leak is not the correction itself, it is the interruption. If you're still building wealth and you have at least 10 years before you need that money, the boring plan is often the smartest one. Not because it is exciting, but because it is harder to sabotage.